All right, first welcome our first guest on the show, Sreesankar, Head of Equities at Prabhudas Lilladher, who now joins in on the show. Sreesankar, hi, good morning. First of all, what would you do with some of these railway stocks on the railway budget? Because you've seen quite a bit of rally, about 200 to 250% in certain names. Good time to book profit?
See, when you say that 200 to 250%, etc., I think that would be my view would be similar story would play out in many of those mid caps, and all these stocks that you mentioned are basically small to mid cap stocks. So you will see that kind of a rally in most of these stocks from the lower levels that these stocks weigh. Because I think on a year-on-year basis, the small cap index is up some 80% on the last 52 weeks, something of that nature. So I would expect every one of these stocks to have a gain of over 100%. From those levels it has achieved. That's number one. Number two, expectations are running high and business confidence has returned, which actually tells you that you will see more of capital investments going forward. If these capital investments goes forward and expectations are also high, then you will see a lot more of investments, capital investments coming from the government towards infra, railways and various other sectors. And this has to be taken as extremely positive. Number three, you've actually seen a freight hike and a passenger hike, though some of the passenger hikes had got rolled back. I mean, it would have affected mostly the metros, not to the other areas to that extent. But the intent is very clear in terms of what you want to do. So if you actually see the intent which we are expecting right now to happen to a reality, then you will actually see much more gains coming forward. But what needs to be waited and watched is whether the next 4 years cash flows are getting discounted on day one. If that's the case, then the stocks will correct. So only time will tell what is going to be the benefits for these companies once a budget comes out and once that intent is very clear.
Okay, fair enough. Sreesankar, I wanted to actually take that point forward. If in case there is a clear intent which is laid out in the budget, and maybe there would be a vision, say even in the union budget on Thursday, about fiscal deficit reduction to a level of around 3% by a certain fiscal year in the next 2 to 3 years, do you think that the market would be satisfied with that, or we could see some correction simply because it's a visionary statement and maybe the fiscal deficit for this year will still be at an elevated level?
I don't think that I can answer that question very easily, because the intent of addressing the fiscal deficit, if it is there and they take steps to address that fiscal deficit issue, it will be taken as extremely positive by the market. But is the budget going to be prudent or filled with populism? It's a different issue altogether. If it's going to be prudent, it's definitely not going to be immediately good for the retail investor and a lot of market participants, because already there are issues about poor monsoon. Sowing is extremely poor. I think rice sowing has been down 58% on a comparative basis when compared to as at even last week. Then you are actually looking at down the barrel in terms of a supply side led inflation happening from the food articles alone, assuming that things remain status quo and you may not have a bumper rains in the month of July, etc. If that's the case, then to address the fiscal deficit, whether the government will be able to take hard decisions which will push up the inflation further is going to be a big question mark. Second is a question of crude oil. And if these tensions in the Middle East continues, and India is one country along with Indonesia which has got a current account deficit in Asia. Now that CAD issue can result into your currency even weakening a bit if you don't see a large amount of inflow. So these things needs to be balanced. So I would think that while a prudent way of looking at the budget in terms of addressing the fiscal deficit is going to be extremely positive, markets are going to be watching how they are going to address it. Because as I said, these inflation levels are going to be an issue. So that also means that probably your interest rates may not come down that easily.
Okay, Sreesankar, I was just looking at your report, and what's interesting is that you're underweight on pharma and FMCG, but have upgraded IT to overweight. or to neutral from underweight. If you can you explain that call to us?
See, we continue to believe that, what we have looked at, a couple of things in that. IT is a sector which is going to be more driven by the global flows, global economic environment rather than the domestic environment to a great extent. So we do not think that there will be headwinds happening in that sector. Our analysts continue to believe that the global demand environment continues to remain robust. If that robustness continues, IT on a global footprint will continue to have a good growth story which has happened. Now, why did we go underweight earlier on IT? Because A, the market was overweight. Second, any strengthening of the currency would have taken away some sheen off from the profitability of these companies to a certain extent. In the change circumstances where the immediate growth in the domestic market becomes a challenge for the next quarter, or probably the growth will get extended by over a quarter. The recovery in growth will get extended by a quarter. You are actually going to see weakening currency also playing up to the benefits for IT. So what we have said is, in this report, the underweight scenario for IT, we do believe that needs to go back to neutral at least.
Okay, some visuals coming in from the Railway Minister reaching the Parliament as well as the Lok Sabha to actually start giving out the rail budget. That will be in 48 minutes. So those are some visuals which are coming there. But the rail stocks, however, have corrected a little bit ahead of the rail budget. So let's see, expectations are quite high in terms of what we can expect, at least in terms of intent with regards to issues such as FDI in railways. But Sreesankar, what is your expectation in terms of key sectors, say the banks, that we can expect on Thursday? Anything specific or any stock specific reaction you'd be looking out for?
No, I think the banks, to me, the banks are a classic case where if growth is going to be stronger, the financials has to run. So the banks will be the beneficiary of it and will continue to remain. That's more of a macro approach. Let's go into the micro aspects of banking. What is bothering these banks? What are the ifs and buts of these, the current rally where it can be punctured? Point number one, banks, especially the public sector banks, needs recapitalization, needs large amount of equity. Now, I'm a firm believer that it has to be a tier 1 equity in terms of plain vanilla equity rather than perpetual bonds and so on and so forth. So the government, how the government will be able to disinvest their stakes or go below 51% stake and allow the banks to keep raising equity as they require it, because that's a basic raw material for banks. That's going to be a big challenge, and how the government is going to address it. That's point number one. Second, we have seen a spate of fundraising in QIPs, etc., even from the companies which are much leveraged. A large amount of projects, at least not 100% of the projects, which are under stress, under NPAs and etc., are stuck due to various levels of cash flow problems. If some of these corporates are able to raise equity, and improve their cash flows, so these projects will get restarted, and as a consequence to it, stress on the bank's balance sheets also will reduce considerably going forward. 3, if the economy continues to grow, even then you will see, as a percentage of the total advances, total credit, you will see a lot more reduction in terms of an NPA. 4, if these things continue to happen, I do not think the kind of numbers which is floating around in terms of capitalization of banks which is required will get reduced considerably. That number will get reduced considerably. I'm drawing a parallel to what happened in 2008 financial crisis, where even in the US, when some ridiculous numbers were being talked about, that the recapitalization that is needed for the banks. That has not happened to that extent. So from the bank's perspective, I think things will continue to look good. But what is more important is, at least in certain areas, there has been talks about write-off of loans of agriculture and so on and so forth. So there is a worry that a lot of farmers, etc., will not repay these loans. And how that is going to get addressed, I'm keenly awaiting for that.
Okay, a lot of things that we all are waiting for, but Sreesankar, any disclosures that you'd like to leave us with?
These are the recommendations that we given to our clients, so clients may hold it.
Okay, fair enough. Thank you very much for taking the time out and talking to us about your fundamental perspective. And remember that you can watch this entire conversation on moneycontrol.com/CNBC TV18 whenever you like. Take a break. But up next, Naresh Thakkar, the Managing Director of ICRA, will talk about the company's strong Q1 results once we're back.